The golden arches worth over $180 billion now stand as a warning sign, not a symbol of success. Once the proud heartbeat of America's fast food empire, McDonald's is facing the most dramatic collapse in its modern history. Sales are sliding, stores are emptying, and the so-called value menu has turned into a luxury for the working class. Families who once fed 4 for $10 now pay 60. What used to define affordability has become a monument to inflation and corporate greed. The truth is no longer hiding behind smiling fries. The empire that fed America is finally breaking down. Across America, the middle-class customer, the backbone of McDonald's success for half a century, is quietly disappearing. The same families that once lined up for $1 cheeseburgers and $5 combo meals are now rationing every dollar. The reason is brutally simple. Wages have flatlined, while essentials have exploded in cost. The median U.S. household income has risen just 2% since 2020 after inflation, but rent is up 22%, electricity 25%, and groceries over 30%. When surviving becomes the new luxury, drive-through indulgence becomes a forgotten habit. McDonald's is paying the price for a broken economic reality. The average fast food meal for one now costs $13.25 in 2025, up from $7.89 in 2019. A family of 4 paying nearly $53 for burgers and drinks has reached a breaking point. Nationwide, 61% of consumers say they've cut back on eating out, and foot traffic at quick-service restaurants is down 5% year-over-year. These aren't opinions. They're symptoms of a class slowly erased by inflation and debt. The numbers tell the story of collapse. Credit card balances have surpassed $1.1 trillion, the highest in U.S. history, while delinquency rates have climbed to 8.5%. The highest since 2011. Millions are juggling car loans, rent, and medical bills, with no room left for discretionary spending. Even a $5 value meal feels like an insult when you're choosing between food and utilities. The fast food industry once thrived on predictable, loyal spending. Today, its core customers are vanishing into overdraft notices. The shift is structural, not seasonal. In 2010, 52% of McDonald's customers came from households earning under $50,000 a year. That share has dropped below 38%, replaced not by wealthier diners, but by no one at all. The loyalty that once defined the golden arches has turned into apathy. Consumers aren't switching brands, they're staying home. And that's the real danger. What we're witnessing is not a temporary slowdown. It's a permanent fracture in America's consumer foundation. The middle class isn't just cutting back, it's being priced out of participation. And when your largest customer base no longer exists, no menu, marketing, or mascot can save you. McDonald's collapse isn't about burgers. It's about the disappearance of the very people who built the empire. The real reason McDonald's and every fast food chain in America are collapsing isn't mystery. It's math. Inflation has rewritten the cost of food from the ground up, and the illusion of stability is built on manipulated statistics. The Bureau of Labor Statistics claims food away from home rose only 3.7% this year, but restaurant owners know the truth. Input costs have doubled since 2020. Beef prices up 36%. Cooking oil up 40%, cheese up 31%, flour up 28%. Even paper packaging is 50% more expensive. It's not one item. It's the entire supply chain being strangled by cost pressures that never reversed. Wages are another ticking bomb. When states like California enforce a $20 minimum wage for fast food workers, that labor cost is passed directly into every combo meal. One fry cook's raise becomes your $14 Big Mac. Combine that with higher rents, delivery fees, and utilities, and the price of survival becomes impossible to disguise. Restaurants raise prices to protect margins, customers retreat to save cash, and sales fall, creating the death spiral now consuming McDonald's. The illusion of moderate inflation exists because government indices hide the pain through substitution and waiting. When beef rises, they pretend you switch to chicken. When rent doubles, they smooth it with owner's equivalent rent. The result? A sanitized CPI that understates reality by half. While officials celebrate disinflation, Americans are living through the sharpest food cost surge in modern history. This economic distortion has shattered the fast food model. The entire $350 billion quick-service industry was engineered for an era when a burger cost less than an hour of labor. That equilibrium is gone. Today, the average fast food employee must work nearly 2 hours to afford one meal at their own restaurant. That's not economics. It's absurdity. McDonald's cannot shrink its way back to value. Its ingredients are trapped in a system where every link, from the farm to the fryer, is inflated beyond control. Even the $5 meal deal they reintroduced in desperation cannot survive the real math. The illusion of value is dead because the dollar itself has lost meaning. Inflation didn't just raise prices. It erased affordability, dismantled trust, and exposed how fragile the American consumption machine truly is. Behind McDonald's polished earnings reports lies a collapsing financial ecosystem. The corporation appears stable only because its pain has been outsourced. Nearly 95% of all McDonald's locations are franchise-owned, meaning the brand's survival depends on thousands of small business operators drowning in rising costs. Corporate collects royalties, rent, and advertising fees, while franchisees face the brutal math of $20 wages, inflated food inputs, and shrinking traffic. On Wall Street, profits still look clean. On Main Street, stores are bleeding cash. A typical franchise owner now pays between 12% and 18% of gross sales back to McDonald's in fees, before paying staff, utilities, or suppliers. Add in local wage mandates and property rent, and many restaurants operate at margins under 5%, some even negative. Across the United States, franchise bankruptcies in the fast food sector have surged over 40% since 2023, with dozens of operators quietly walking away from their contracts. McDonald's masks the damage by counting new store openings as growth, but most expansion is cannibalization, replacing failed outlets with debt-financed new ones. This is the corporate illusion of profit. Numbers rising, reality falling. McDonald's reports steady revenue because franchisees continue remitting payments, even while sinking deeper into debt. Some are taking out high-interest loans to stay compliant with brand mandates. Remodeling requirements, equipment upgrades, and digital kiosks cost hundreds of thousands per location. When your restaurant's traffic falls 4% per quarter, there's no recovery path, just a slow bleed hidden beneath the golden arches. The system's imbalance is now irreversible. Franchisees can't raise prices without losing more customers. They can't cut wages without violating state law. Meanwhile, corporate headquarters demands growth targets tied to executive bonuses. The result is a mathematical impossibility: profit for one side, survival risk for the other. This isn't business competition anymore, it's corporate triage. McDonald's may look healthy in quarterly slides, but its network of operators, the true engine of the empire, is running out of oxygen. What Wall Street calls resilience, franchisees call collapse in slow motion. McDonald's collapse is only the first tremor in a much larger implosion. The entire fast food ecosystem, once America's most recession-proof industry, is unraveling in unison. Every chain built on the illusion of cheap convenience is now confronting the same arithmetic. Fewer customers, higher input costs, and vanishing profit margins. In the third quarter of 2025 alone, Wendy's traffic fell 6% to 12%, Burger King declined 3% to 11%, and Jack in the Box plunged 7.7%. The model that fed millions through low-cost volume no longer works in an economy where volume itself has disappeared. Across the U.S., franchise closures are accelerating. Small operators, who make up 90% of the quick-service industry, can't absorb the shock a typical store needs foot traffic growth of 3% annually just to offset inflation. Instead, it's declining 4 to 6%. Lease costs are up 19% since 2020, commercial insurance up 28%, and debt refinancing rates have tripled since the Fed's tightening cycle. Even giants like Starbucks are cutting underperforming stores, while Taco Bell and Subway quietly delay remodel programs to preserve cash flow. The illusion of stability persists only because chains keep opening new outlets to disguise failures elsewhere. A deeper structural collapse is underway. The consumer base that once supported 200,000 fast food locations nationwide no longer exists in the same financial condition. Combined industry sales may still show nominal growth, up roughly 4% year over year. But inflation-adjusted revenue is negative for the third consecutive quarter. Investors see record dollar figures. Operators see empty dining rooms. What's happening to McDonald's isn't isolated mismanagement. It's contagion. Fast food giants share the same customer demographic, the same supply chain, and the same inflationary chokehold. They're fighting over a shrinking market, not an expanding one. Every new value menu is just a race to the bottom that none can afford to win. The collapse now moves like falling dominoes, chain after chain, city after city. What was once America's most reliable industry has become its loudest warning. When even fast food fails, it's no longer about taste or marketing. It's about a nation that can't afford its own hunger. The collapse of fast food isn't just about prices. It's about the destruction of the system that moves and serves it. The logistics and labor backbone of America's consumer economy is fracturing companies like UPS, FedEx, and Amazon. The arteries that supply every franchise and deliver every shipment are bleeding efficiency and profitability. At once, UPS alone has eliminated 48,000 full-time jobs since early 2025, shuttered 93 facilities, and cut over $2.2 billion in operational costs. Yet its domestic profit margin has plunged to 6.4%. Less than half of what it was a decade ago. FedEx has fallen to 6%, mirroring the same downward spiral. These numbers reveal a grim truth. Productivity is up, but prosperity is down. Workers are making less, working harder, and delivering smaller margins. A typical UPS driver now faces 120 stops per day, double the workload from 10 years ago, while new hires earn nearly 50% less than veterans once did. The new corporate model replaces full employees with gig workers using their own vehicles, erasing benefits and long-term security. Labor is being squeezed until it breaks, and the quality of service breaks with it. The fast food industry depends on this same network: daily refrigerated shipments, overnight supply chains, hourly delivery coordination. When the carriers that deliver buns, meat, and packaging can no longer afford fuel or staff, the entire food system destabilizes. Higher logistics costs ripple straight into the menu board, compounding an already unsustainable price structure. This meltdown extends beyond trucking and warehouses. It's the erosion of the American work contract itself. Every corner of the low to mid-wage economy now runs on overwork and underpay. And when a system that relies on human speed reaches its physical limit, no automation or rate cut can save it. The arteries of the consumer economy are clogged, and the heart of affordability has stopped beating. Fast food, logistics, and retail all pulse to the same rhythm, and that rhythm is fading fast. What's holding this broken system together isn't strength, it's manipulation. The modern US economy no longer allows natural downturns to reset imbalances. Instead, it operates under an unwritten rule: recessions are illegal. Every sign of contraction is buried under fabricated optimism, redefined metrics, or printed money. The Bureau of Economic Analysis can revise GDP upward. The Bureau of Labor Statistics can seasonally adjust unemployment. The Federal Reserve can flood markets with liquidity. And the illusion of stability continues. But illusions can't pay rent, and they can't refill empty drive-thrus. Since 2008, America has created over $28 trillion in new debt to prevent recessions. The national debt has now crossed $38 trillion, and annual interest payments have exceeded $970 billion, surpassing what the country spends on defense. In practical terms, the government borrows money to pretend prosperity still exists. Each bailout, stimulus, and rate cut stretches the rubber band tighter. What used to be a normal economic cycle has turned into permanent emergency management. This endless interference has created a distortion field around every industry. Corporate giants are shielded from collapse. while small operators like McDonald's franchisees or delivery drivers face the real crash without safety nets. It's not capitalism anymore, it's maintenance of illusion. When interest rates rise, the government panics. When they fall, inflation accelerates. Either way, the system burns from both ends. Even now, the Fed cuts rates to stimulate growth, yet mortgage rates rise in response as investors reject devalued dollars. Treasury yields climb, signaling loss of faith in U.S. debt. The world's reserve currency is behaving like a credit card maxed out by its own issuer. The result is an economy that refuses to breathe. Artificially propped markets, manipulated labor data, and trillion-dollar fiscal bandages have replaced reality. America hasn't abolished recessions. It's postponed them so long that the next one won't be a dip. It will be the reckoning of everything that was never allowed to fall. The illusion of stability in America's consumer economy is collapsing because its foundation was never organic demand. It was government subsidy. Over 42 million Americans depend on SNAP benefits to buy food, a number greater than the population of California. These benefits quietly support not just households, but the entire retail and restaurant ecosystem. When that federal money stops flowing, the economy doesn't slow, it shuts off. The upcoming reduction in SNAP allocations is set to erase over $12 billion in monthly consumer spending almost overnight. For grocery stores, that's more than half of all low-income sales. For fast food, it's catastrophic. McDonald's, Walmart, Dollar General, and thousands of regional grocers rely on these government-backed dollars disguised as consumer choice. SNAP isn't charity, it's a corporate lifeline. When subsidies shrink, demand doesn't shift to another store, it vanishes. Analysts already estimate that 1 in 4 grocery outlets in rural and low-income urban areas could close within a year if SNAP support continues to fade. That means entire neighborhoods, millions of people, will lose both their income source and their access to food simultaneously. The consequences extend far beyond checkout counters. Retail workers lose hours, distributors lose contracts, trucking routes vanish. The collapse cascades upward. What begins as a small adjustment in federal spending becomes a nationwide demand blackout. The data is already flashing red. Food insecurity has surged by 33% since 2022, while delinquencies on grocery credit lines have tripled. Consumers are now paying for groceries on debt, and that debt is expiring. This is the final connection in America's failing chain. When subsidies vanish, the illusion of consumer strength disappears with them. Without SNAP, without credit, without stimulus, the fragile balance holding retail and restaurant sales evaporates. McDonald's can survive wage inflation or high beef prices, but not a customer base that no longer has money. The coming retail blackout won't just dim store lights, it will reveal how dependent the entire economy has become on borrowed demand. Every signal flashing across the U.S. economy today mirrors the same warning lights that blinked before the Great Depression. Overvalued markets, manipulated data, overextended debt, and the illusion of endless prosperity. It's all been written before. The only difference is scale. In 1929, the Dow collapsed from 380 to 41. Today, it's leveraged on debt so massive that a similar correction would erase $30 trillion in paper wealth and destroy every false assumption propping up modern life. McDonald's, collapsing foot traffic, franchise losses, and vanishing customers are just the first symptoms of a deeper disease. A civilization addicted to consumption that no longer pays for itself. Fast food was never just about meals. It was about motion. It represented speed, convenience, affordability. When that system falters, it means the engine that powered the American middle class is seizing. The SNAP dependency, the logistics strain, the manipulated data, they all converge into one truth. The U.S. economy has been running on artificial life support since 2008, and the machine is now overheating. For decades, policymakers believed they could bend economic gravity, print, borrow, and stimulate their way out of every correction. But the longer recessions were delayed, the greater the imbalance became. The Federal Reserve has already injected more liquidity in the past 5 years than it did in the entire 20th century. Debt no longer fuels growth. It suffocates it. Every rate cut intended to save the economy weakens the dollar further. Every bailout protects the unproductive, and every subsidy destroys real price discovery. What's collapsing isn't the fast food industry. It's the entire illusion of permanent prosperity. The parallels to 1929 are haunting. Back then, speculation replaced savings, and consumption replaced productivity. Today, we repeat the same pattern on digital steroids. Trillions created out of nothing, markets detached from labor, and citizens detached from reality. Then, the Great Depression lasted 25 years before full recovery. Now the next downturn could last even longer because this time, there is no gold standard, no surplus labor force, and no industrial base left to rebuild from. We've already outsourced the foundation. And yet, there's a moral collapse beneath the financial one. The generation that survived 1929 knew hardship as normal. They rebuilt because resilience was cultural. Today's society, softened by decades of credit and comfort, cannot imagine a decade of contraction. The law against recessions created a population unable to withstand one. What follows will not be a crash. It will be a reset of everything people assume to be permanent: jobs, currency, affordability, even stability itself. As the subsidies fade, as retail lights go dark, and as even the icons like McDonald's close their doors, America will confront a truth it's avoided for half a century. You cannot fake growth forever. Every illusion ends when the math stops working. The real Great Reset won't be digital, it will be economic. And when the last dollar meal disappears, it won't just mark the end of cheap food, it will mark the moment a nation finally realizes it can no longer afford its own denial.